Hi, Else here, and we're continuing our discussion about non-monetary exchanges. Recall that a non-monetary exchange is when we give up one asset, like a forklift truck, in exchange for yet another asset, another forklift truck. Or we exchange our forklift truck for something different, like a scanner/printer/photocopier for our office. How do we record these types of non-monetary transactions? There are two questions we need to answer in order to record these transactions. 1. At what value should we record the asset we received? And 2. Should we record a gain or loss on disposal of the old asset that we gave up? The answer to both of these questions is determined by asking ourselves, does this asset exchange have commercial substance? What is commercial substance? Commercial substance is when there is a significant change in the future economic benefit, the value, that the entity can expect to receive from the capital asset acquired when compared to the capital asset given up. That likely doesn't help to clarify this concept. Let's try again. Commercial substance means one of two things. Either the amount, timing, or risk of future cash inflows from the asset received is significantly different than that of the asset given up, or the value of the entity's operations has significantly changed due to the use of the new asset. Note that the concept of value here is specific to the part of the entity that exchanged the asset and not the whole entity. Now, I'm pretty sure that my explanation for commercial substance blew your mind, but it likely didn't clear up your understanding of what it is. So let's do a few examples to clarify. First, let's examine the concept of a significant change in the amount, timing, or risk of future cash flows between the asset you give up and the asset you receive. Say you have an old forklift truck with a carrying value of $7,000 and a fair value of $12,000. You give up this forklift truck plus $20,000 cash in exchange for a brand new forklift truck with a fair value of $32,000. Does this exchange have commercial substance? Well, the cash you gave up has no risk with regards to its amount or timing. Cash is, after all, cash. What you got is totally different, since the amount, timing, and risk of the cash flow you will get from your new forklift truck cannot be determined with any assurance. Therefore, this transaction would have commercial substance since the configuration, meaning the amount, timing, or risk, of the expected future cash flows has changed. You meet the first criteria and have to record a transaction with commercial substance. What if you exchange your old forklift truck for some used office equipment? Here again, the pattern and timing of the expected future cash flows is different. You would never use your office equipment in the same way you used the forklift truck that you got rid of. This transaction therefore has commercial substance. Let's move on to another reason why an exchange would have commercial substance. The value of the entity's operations will change due to the use of the new asset. What does this mean? First, it should be noted that this statement applies to the specific part of the entity that exchanged the asset, and not the whole entity. That's because an exchange of assets may not have a significant impact on an entity as a whole, but it may have a significant impact on the part of the entity that made the exchange. Therefore, this test of significance is for only the part of the entity that exchanged the asset. One example that would illustrate this concept is if you gave up your old forklift truck in exchange for 4 hydraulic movers. You are still using the hydraulic movers to do the same thing as your old forklift truck, which is to pick and fill customer orders. That means it is likely that the amount, timing, and risk of future cash flows is the same before and after the exchange. We don't meet test number 1. However, the use of the hydraulic movers will significantly reduce the amount of time it takes you to pick and ship out your customers' orders. In this case, due to efficiencies, the value of the distribution center's operations have improved due to the exchange, and the exchange therefore has commercial substance. Another example would be if the exchange resulted in economies of scale. That means that after the exchange, you would have a cost savings because of getting and using the asset you received in the exchange. For instance, say you exchanged 2 old welding machines for one larger new one that can weld at higher temperatures, improving the speed of your welding. You don't complete any more orders than you had before, but you are able to complete the orders faster. You can now divert your extra time to other projects. Overall, your division's economic position has improved, even if you don't sell any more welding services than you did before the exchange. So, this second test of commercial substance speaks to the entity involved in the transaction, their position before and after the exchange. However, the first test for commercial substance speaks to the objects or items that have been exchanged and their ability to generate future cash flows. If an exchange meets either of these two tests, then it has commercial substance. If an exchange has commercial substance, then IFRS states that the non-monetary transaction must be accounted for on the same basis as a monetary transaction. Record the acquisition of the new asset using the fair value of the asset given up, unless the fair value of the asset received is more readily determinable. Any gains or losses are recognized immediately into income. I'm going to repeat that process again, just to be sure you got it. If an exchange of assets has commercial substance, you record the new asset at the fair value of the asset given up, unless the fair value of the asset received is more determinable, and the gain or loss on the exchange must be recognized on the income statement immediately. Two concepts are embedded in this process which we have to clarify. 1. What is fair value? And 2. Why use the fair value of the asset given up? Let's start with what is fair value. Fair value is what you would get for the asset if you sold it today. However, that may be more difficult to determine than you think. Here are a number of alternative measures of fair value, and they are all acceptable. It could be the market price of an identical asset, say the same forklift truck with the same mileage and condition which had just been sold at a dealership. Or it could be a quote from a supplier of the same assets, both new and used. It might be an appraisal received from an experienced supplier, although this can be subjective as different appraisers might provide totally different appraisal values. We could use prices for similar, but not identical, assets, adjusted for differences such as age, operating efficiency, and capacity. Or we could use published information on average prices for specific used assets, such as the Blue Book value for cars. All of these are acceptable measures of fair value. Now that we understand fair value, let's better understand why IFRS requires you to use the fair value of the asset given up first, unless the fair value of the asset received is more determinable. Why do we use the fair value of the asset given up instead of the asset received? I think an example would help you to understand this concept. Say you sold an old forklift truck for $14,000. That's what you got, $14,000 cash, and that's all the money you would have to go out and buy a new forklift truck. If the new forklift truck is worth $17,000, you would not be able to buy it unless the entity selling the new forklift truck was willing to accept $14,000 and lose $3,000 on the sale. It is for this reason that we use the fair value of the asset given up first, because if we sold the old asset and got cash, that's all we would get for it. Since the purchase of the new asset is the second transaction after the sale, we should use the fair value of the asset given up to record the transactions, since what we receive from the sale of the asset would happen first. When does this not apply? When the fair value of the asset received is more determinable. For instance, If we give up a patent in exchange for a piece of land in Toronto, we should use the value of the asset given up, which is the fair value of the patent. However, it's likely that the fair value of the land is more determinable, since land in Toronto is bought and sold regularly, and there are many real estate agents who we could get an appraisal from. The patent might be a one-of-a-kind item, so a fair value may be impossible to determine. In that case, we would use the value of the asset received, the land, to record the exchange, since the value of the asset given up is not determinable. Let's summarize what we've learned so far in steps, so we know how to approach a question on a test or exam. Step 1. Read the scenario and ask yourself, does the exchange meet either of the following two tests? Test 1. The amount, timing, or risk of future cash inflows from the asset received is significantly different than that of the asset given up. Or, Test 2. The value of the part of the entity's operations will significantly change due to the use of the new asset. If the answer to either of these statements is yes, then the exchange has commercial substance. Step 2. Since the change has commercial substance, determine which fair value to use to record the exchange. Always use the fair value of the asset given up, unless the fair value of the asset received is more determinable. Step 3. Record the entry for the non-monetary exchange with commercial substance by removing the carrying value of the old asset from your records, recognize the fair value of the asset received in the exchange, and report the difference as either a gain or loss on exchange through net income. That's it. Seems fairly straightforward, although it can be complex. For that reason, in my next video, I'm going to do a few examples of non-monetary exchanges with commercial substance.